Title: The Synchronized Symphony: How the Business Cycle Conducts the Performance of Stock Market Sectors. Introduction. In the symphony of financial markets, the business cycle emerges as a maestro, orchestrating the movements and fortunes of various sectors. Understanding the intricate dance between the business cycle and sector performance is pivotal for investors seeking to harmonize their portfolios with the prevailing economic rhythms. This exploration delves into the profound impact the business cycle exerts on different sectors in the stock market, illuminating the cyclical dynamics that shape investment landscapes. The business cycle unveiled. The business cycle, a perennial force shaping economic landscapes, undergoes four distinct phases: expansion, peak, contraction, and trough. Each phase brings forth unique challenges and opportunities, influencing the performance of sectors in the stock market. Recognizing these patterns allows investors to adopt a strategic approach, positioning their portfolios to navigate the undulating terrain of the business cycle. Expansion phase, asterisk. As the economy emerges from a trough, entering the expansion phase, sectors sensitive to economic growth tend to outperform. Industries such as technology, consumer discretionary, and industrials thrive during this period. Technology companies capitalize on innovation, consumer discretionary sectors benefit from increased consumer spending, and industrials flourish amid heightened demand for goods and services. Investors seeking growth opportunities often find favor in these sectors as the economy gains momentum. Consider the tech sector during an expansion phase, where companies pioneering breakthrough technologies experience soaring stock prices. Consumer discretionary stocks, including those in retail and entertainment, witness increased demand as consumer confidence and spending surge. Industrial giants supplying essential goods and services flourish, exemplifying the symbiotic relationship between economic growth and sector performance. Peak phase, asterisk. As the economy reaches its zenith, entering the peak phase, dynamics shift. Sectors that thrive during expansion may experience a slowdown, while defensive sectors come to the forefront. Defensive sectors, such as utilities, healthcare, and consumer staples, showcase resilience during economic peaks. These industries provide essential goods and services that maintain demand, irrespective of economic headwinds. For instance, utilities, often characterized by stable cash flows, become attractive to investors seeking safety and income. Healthcare, an evergreen sector, remains robust as the demand for healthcare services persists. Consumer staples, encompassing necessities like food and household items, exhibit consistent demand, buffering investors against the volatility that may afflict other sectors during the peak phase. Contraction phase, asterisk. As the business cycle transitions into contraction, also known as a recession, the performance landscape undergoes a metamorphosis. Sectors closely tied to discretionary spending, such as technology and consumer cyclicals, may face headwinds. Conversely, defensive sectors continue to demonstrate resilience. Investors adopting a defensive stance might reallocate assets to sectors less susceptible to economic downturns. During a contraction phase, technology companies may experience decreased demand for non-essential products, impacting stock prices. Consumer cyclicals, including automotive and luxury goods, often witness declines as consumer spending contracts. In contrast, defensive sectors like healthcare and utilities maintain stability, providing a refuge for investors seeking safety amidst economic uncertainties. Trough phase, asterisk. The trough phase, marking the nadir of the business cycle, sets the stage for recovery. As economic indicators show signs of stabilization, opportunities arise for cyclical sectors to rebound. Industries such as materials, energy, and financials, which faced challenges during the contraction phase, stand poised for recovery. Investors with an appetite for risk may find value in these sectors, anticipating a resurgence in economic activity. Consider the energy sector during a trough, where oil prices, battered during the contraction phase, exhibit signs of recovery. Materials companies, integral to infrastructure projects, become attractive as governments embark on stimulus measures. Financials, often closely linked to interest rates, may rebound as central banks implement policies to stimulate economic growth. Interplay of sector rotation, asterisk. The business cycle's impact on sector performance underscores the importance of strategic sector rotation in investment decisions. Investors adept at recognizing the shifting economic winds can capitalize on opportunities, rotating their portfolios to align with the prevailing phase of the business cycle. Sector rotation not only enhances portfolio resilience but also positions investors to capture potential upside during periods of economic expansion. For instance, a well-timed rotation from technology stocks to defensive sectors as the business cycle approaches its peak can shield investors from potential downturns. Similarly, a strategic shift towards cyclical sectors during the early stages of recovery can position investors for optimal gains as economic conditions improve. Conclusion. Asterisk. In the grand orchestration of the stock market, the business cycle emerges as a guiding force, shaping the destinies of various sectors. Investors attuned to the nuanced movements of the cycle can navigate the undulating terrain with precision, strategically positioning their portfolios for optimal performance. From the crescendo of expansion to the protective embrace of defensive sectors during peaks, contractions, and troughs, the business cycle conducts a synchronized symphony of opportunities and challenges. For investors equipped with a discerning ear, the ability to dance in harmony with the ever-changing melodies of the business cycle becomes a key determinant of long-term success in the dynamic world of stock market investments.